You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody, that music means it's time once again for Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. And today's guest is yet another newcomer to the program and indeed to the network. He is Mike Beller, the CEO over there at Thesis Technologies. Mike, welcome to the Options Insider Radio program.
Hi, Mark. Thanks for having me on.
Well, Mike, as we are wont to do with all of our first-timers here on the old program, why don't you go ahead and give our audience a little bit of an overview of your background in the trading technology landscape and how you found your way over there to Thesis.
Sure thing. Thesis was actually founded in 2009 as a subsidiary of TradeWorks. TradeWorks was founded in 1999 as a financial technology firm, and I joined in 1999 as its chief technology officer. We kind of pivoted in 2001 and became a quant asset management firm and built up a business there. And in the later years of 07, 08, we found that increasingly we were investing our money in trading technology. The costs of building low latency trading and colocation and all of those things were growing, and we were spending a lot on people who could help us build really high performance trading systems. And that was another pivot point for us at TradeWorks. And we decided to start Thesis Technologies to take that cost center, essentially, that growing cost center, and turn it into a profit center by making our trading platform available to other firms and institutions. And so I kind of went through the multiple transitions of first, joining a fintech in 1999 before the word fintech existed, and then pivoting and becoming a trading technologist and building out trading systems as Reg NMS was happening, decimalization was happening, and things were changing rapidly. And then to run a tech company, starting a tech company in 2009 and becoming the CEO in 2015. So it's been a long haul. And what Thesis Technologies does is we build out a trading platform for low latency access to the markets and feeds and things like that. We build matching engines, very high performance, scalable, low latency matching engines that run, for example, alternate trading systems. And then more recently, we have been building financial big data systems. In 2012, we delivered the Midas system for the Securities and Exchange Commission to help them be able to visualize all this data in the markets. And ultimately, that led to our bid for the Consolidated Audit Trail, which brings us to 2017 when we were selected for that. So that's a real thumbnail sketch. But basically, you could say that we're pretty well embedded in the capital markets as far as high tech for the capital markets.
Yeah, you certainly have been around, seen a few things in the space, and that is a pretty interesting path that a lot of firms are going down or have gone down in recent years. And a lot of trading firms and others start to realize, hey, we're spending a lot of money on this tech thing, and we're developing some cool technology for our own purposes. Maybe we could turn around and start utilizing that and actually putting that out there to the marketplace. And we've seen a lot of new entrants into the space. And you're right. We used to just call them vendors. Now it's fintech is, of course, the hot term for it. But a lot of people entering that that fintech/vendor space and providing interesting new services to that audience. So a lot of interesting stuff there. I want to get into that, but you kind of touched on the lead there. And of course, one of the reasons you're on today is to talk all things CAT. CAT, of course, standing for Consolidated Audit Trail. If you're not familiar with that, listeners, of course, it's been a big deal for a while on the regulatory side of the space. Regulators have known for a long time that they've really needed to have more insight into what's going on in the space. You know, everything we've talked about in recent years has always been high frequency, low latency execution in sub-second timeframes. Yet the regulators didn't have that degree of insight into the marketplace. So if they lacked that, of course, it was hard for them to crack down on the abuses that were going on there. Hence the birth, or the interest in, I should say, the Consolidated Audit Trail. It was a big deal. There were a lot of firms fighting for this contract. I believe it was over 30 at one point. So maybe we'll start there. How did you guys at Thesis eventually triumph in this process? I know it was a long drawn-out process. Was it eventually you guys just had more stick-to-itness than the rest of the crowd, or how did you guys end up winning this contract?
Well, you know, it's a great question, and you know, one never knows all the elements that go into being selected for something like this. It was a 4-year process, and I think that while you know we've never been told exactly what all the elements are that you know made any individual SRO to have a decision because they have to make a vote. We do believe that a lot of where our the way we stood out was by innovating in terms of how a regulatory technology system could be built. So we thought about this deeply way back in 2013 when the bidding process began. And since we've been, you know, on the other end of it, let's just say, having had to report to OATS, for example, for years and understanding the complexity of reporting to that system and maybe some of the shortcomings in how it was originally built. And then also having the perspective through developing the MIDAS system of understanding how the regulators need to see the data, I think we had some unique insight. And we decided on a 3-point plan. And the 3-point plan was make it easy to report to, make it useful, make it secure. And what we mean by that is, in general, it seems to me that previous regulatory systems weren't designed to be easy to report to. That was an afterthought, right? Let's just get the regulator the data they need. The regulator decides. They're not necessarily super highly motivated to make it easy for the reporters to report. But that seems like a mistake. You know, if you're building out a system that's going to provide this central reporting for the entire industry, one of the first places you should focus on is, you know, make it easy to report to, support multiple formats, support also really good, fast feedback, as opposed to waiting a long time to know whether you've reported successfully. So these were some of the concepts in our bid. And then on the useful side, we really wanted to make sure that the CAT wasn't just a data dump, that for the regulators, it had all the analytics it needed in order to make it easy for them to do their jobs. And we had a lot of good insights into that from building out the MIDAS system. And then, of course, perhaps more important than all of these things, the system has to be secure, and there has to be a higher standard of security for this system than a typical system, because it's going to maintain and store and provide access to regulators for some very sensitive information. And so we innovated in all of these areas. And in doing that, I believe we put ourselves in very good stead, because, you know, our competition were 30 companies that initially intended to bid. Almost every single one of them was way bigger than we were as a firm, and maybe way more well known. SunGard, all kinds of like really big firms, and in the end, we won.
I can't imagine fighting for a project like that for 4 years. So congratulations to you on just having the fortitude to fight all the way through the process to the end. That alone is something in and of itself, if even going as far as to winning the ultimate contract. Now, you hit on a lot of the issues I want to touch on, of course, security and all that becoming top of mind a lot these days. But before we even get into that, let's give our listeners a bit of an overview of kind of the current status of this Consolidated Audit Trail. A lot of listeners may know that it was scheduled to effectively go online back in November, and I guess that didn't really happen, but it kind of did. I guess that maybe you can break that down a little bit for us. You know, where do we stand now? There is, correct me if I'm wrong, but there is data currently flowing into the CAT, but it's not technically live. Is that correct?
The CAT is not officially live, and the reason is that there are key aspects of the. We'll take a step back for a moment. There was a rule created by the SEC, Rule 613. This rule required the SROs to band together, as they do in the national market system, and create an NMS plan in the same way that there's an NMS plan for the SIPs, okay, the centralized feeds, Opera, et cetera. Those are all under an NMS plan. So the SROs had to band together, create an entity which they called CAT NMS LLC. And CAT NMS LLC had to essentially run the RFP process, ultimately selected us, and then we went through in January, February, March and created a contract for building out the CAT, and that contract was signed on April 6th. From that point on, we were up building out parts of the system, providing initial versions of technical specifications, et cetera. But the plan has a number of steps that have to happen for the CAT to go live, some of which include certain cybersecurity steps and checks that have to be completed before it can go live, and those have to be done collaboratively by Thesis as the processor and CAT NMS as the SROs, or the SROs themselves. And so right now we're in a state where some of those things have happened, and a few of them still have to happen before the system can go live.
So I suppose the technical deadline for this to all go live is now November of 2018. Is that correct?
There isn't an official new date. So what happened was a couple of months ago, might have been just a couple of weeks ago, seems like a long time, the SROs reached out to the SEC and requested what's known as exemptive relief for a new schedule, and there's currently an ongoing discussion between the SROs and the SEC on that revised schedule.
You mentioned security, and that's obviously an issue I want to talk about because it's top of mind for a lot of people. The CAT was always, I think you can charitably call it a controversial issue, even from the get-go. People clearly saw a need for it, like I mentioned before, but a lot of firms in the industry were also, as you might understand, reluctant to really part with a lot more data, let alone have it be aggregated in this centralized database that could be accessed by pretty much anyone in the industry. So there was a lot of pushback against that to begin with. And then, of course, we are all living now in a post-Equifax world where cybersecurity is very much top of mind. We saw that with the chairman of the SEC and a few others who seemed to be reticent, shall we say, about the CAT. In fact, I just saw the CEO of SIFMA recently talking about the CAT and some of his concerns he had, including the fact that there was a lot of effectively PII, personally identifiable, easy for me to say, personally identifiable information to be gathered in this one central repository that could be accessed by virtually anyone in the industry. So it seems like that's been a bit of a hang-up. Would you say that this is maybe all a bit of a result of Equifax and people suddenly having to take a second look, a hard look at everything cybersecurity, or do you think maybe this was going to be inevitable from the get-go with the CAT?
It's not clear. One of the things I will say is that cybersecurity was something we were thinking about from the very beginning of when we began working on our bid for the CAT, because these cybersecurity breaches are not a new phenomenon. I mean, I'm trying to remember. Okay, let me think back to the 2013, the year in which we started to bid on the CAT. I believe there was the Target breach. I think the JP Morgan breach. There were a lot of big breaches that year. So it is a question as to why now. I think that it could just be that a matter of timing. The CAT was coming due, and at the same time, Equifax happened, and perhaps that just raised concerns. And so, I believe that we should be very, very thoughtful and careful in building out the CAT. And so, people wanting to make sure that everything's being done right from a security perspective is something that I thoroughly respect. And we are doing everything we can to make sure we do everything right from a security perspective. I think that what we should understand, though, is that the plan itself contemplated the cybersecurity environment and has extensive requirements for cybersecurity built into it. And I think that what's needed in order for the CAT to be secure is to complete that plan. Complete the steps in that plan, excuse me.
Now, it seems like, like I said, the sticking point for a lot of these people, whether they're fixating it just now on it now because of Equifax or whether it's been their concern all along, like I said, I don't know. But it does seem like a lot of them are fixating on this aggregating of personally identifiable information and whether or not that's really integral to the whole process. I thought I'd ask you, as a person who's building the CAT, what are your thoughts on that? Is that information, is that really integral to the entire database, or Do you think it can be removed? And if so, is that something you guys are considering to maybe help remove this one stumbling block to get the ball rolling again?
Well, CAT has a number of improvements over previous regulatory systems. So you said, people are concerned about aggregating all this information, but I think the reality of it is increased scrutiny is both necessary and desirable for us to maintain the quality of markets and the reputation of our markets. So the question is just what's the best way to do it? And we need a new system. We can't use the old system. The scale and the order of magnitude of data that's increased since the last system was designed is by a factor of 100 or at least a factor of 20 in terms of the number of messages for every order from the time that OATS was first rolled out. So we need a new system. And one of the most important distinguishing features of this system, a very important one, is its ability to help trace issues and problems down to the people who are causing those issues and problems. And that is a shortcoming of the current system. Right now, that's a complex analysis where people try to do an analysis on the data that they have, the OATS data, and then they have to use EBS once they've kind of figured out that maybe something's going on, but there's no single designated identifier for a trader. Now, whether that means there has to be complete personally identifiable information for every single investor in the U.S. markets stored in the CAT is something that's under review, and the chairman has specifically said, Chairman Clayton, that is, has specifically said that he's going to have that review and make sure that the correct decisions are made there. And we support whatever answer comes down from the commission on that. I think that they understand the regulatory need far better than we do. We just believe that it's important that the CAT in some way be able to identify who's doing the trading, or it will be harder to, for example, identify insider trading and other market manipulation that we have to make sure that we can catch.
It would seem like that would need to be functionality that's available somewhere down the chain to eventually identify. If you spot some information, you should be able to eventually trace it back to someone. So somewhere along the chain, there needs to be something that you could translate at least into a person identifiable information. Some people are saying maybe some fleeting, unique identifiers that are only used once and can't be really traced back without some other, deep technological work. So maybe there are some workarounds. Doesn't sound like you're too concerned at the end of the day. This will be too big of a stumbling block for you.
Not for us. We're prepared to protect the personally identifiable information, but we're also prepared to make changes if the commission changes the rule to have a different way of doing things.
Let me ask you this, Micah, on a personal level, just me and you talking, no one listening here, but you spent 4 years getting this bid, now all this other rigmarole developing as a result. The project still isn't seen to completion. Did you ever say to yourself, what have we done? Why did we take this on? This is just a monster not of our own making.
No, look, here's the thing. This is an important change for the markets. The reality of it is regulatory scrutiny is not a transitory thing. It's happening because there's a gap between the regulators' abilities to surveil the markets and the most sophisticated market participants' ability to visualize the markets. And that gap creates a problem for everybody, because when there's doubt or question about whether our markets are being properly surveilled, then that leads to lack of confidence in the markets. So point number one, this is something that has to happen, and it's really part of a secular trend towards improved ability of regulators to see what's going on in the markets that we at Thesis believe is important. We believe that market transparency is an important cleansing force, and I think all of us agree to that. And so that's point number one. And point number two, it's an honor for us as longtime market participants and as technologists to be selected to make it happen. Nothing important ever happened really easily. So, we're on it, we're here, and we're going to do what it takes.
Sounds like a plan. Well, let's pivot away to maybe some happier topics that have some things we could talk about that are more concrete and aren't completely up in the air. Of course, we were just talking regulation. That's still a hot area in the technology space as well. I mean, RegTech is kind of where a lot of the action, if not all of the action, in fintech is these days. Every time I go to an event or a conference or a quote-unquote fintech symposium or event, there seems to be more than a few firms out there playing on the reg tech side of the fence, and who can blame them? There's a huge regulatory mandate in the space these days. A lot of firms are being forced to spend money in this area. So if you see that as a startup, you of course smell opportunity. And you, as you mentioned, Mike, at the top of the show, you've been involved in many different aspects of the space and currently are over there at Thesis, many different areas, including on the reg tech side. So I'm curious for you, as been a watcher of this area of the space for quite some time, what are some of the interesting trends you're seeing out there that are catching your eye right now that are maybe hot and new and different?
So in RegTech in particular, I think, one of the things that seems to be happening is that you have a trend going on, and it's not rolling out at the same pace in all asset classes. But that trend is towards increased data volume per transaction. And what I mean by that is you don't necessarily have an enormous increase in the total notional volume of each of these markets. But what you do have is a lot more orders and cancellations and things, a lot more data that need to be processed in order to get a trade done. And that happened in nowhere more pronounced, perhaps, than in the equities markets in the 2000s, when you had decimalization at the very end of 1999, and then you had Reg NMS in the mid 2000s, and the combination led to an explosion of probably, 100-to-1 increase in messages to trade. So trades and trade volume didn't go up by that much, although the trades did fragment somewhat from an average order size of a couple hundred shares down to an average order size of 100 or something like that. But the point is not enormously. But the number of messages per trade just went up by just such a huge amount. And that had a huge impact on people's data strategies. So their initial reaction was, well, okay, I'll hang on to the trades. I'll keep track of what information was current at the time of the trade. And then I'll take all these messages that I got in the meantime. I'll just put them in files. That kind of worked for a while until the flash crash happened and regulatory scrutiny increased, and people realized that they were constantly being asked about not just what was in their Oracle databases, which only had the trading information, but also about what was happening in all those files that they really weren't doing anything with. And so, this is the most marked example of this is in equities, but the fact is that as electronification and algorithmic trading increases across asset classes, you're seeing a similar thing happen there. Increased amount of data that needs to be processed in order to understand what's going on in the market, and then people having to examine their data management strategies in order to either be able to report, on the one hand, if they're a trading firm, or to regulate. Either one of those parties has to have much more scalable data systems for that. And so that's kind of the biggest trend that we're looking at there is this issue of the data explosion in regulatory technology.
It's funny you mentioned that in the reg tech perspective, because that's an issue that we've been wrestling with in the option space for the better part of the last decade. If you talk to any service provider, any vendor, any tech firm in the option space, and they're going to just lament to you how the massive fire hose of data coming out of Opera is just exploding at a near exponential pace and continues to grow. I mean, of course, you could think about it. You see a stock or another simple type binary instrument like that. That the amount of data coming out of that is relatively small. But now you look at the option series on that. Take a Google, for example, and you have thousands of different series across months, and the calls and the puts and the strikes, and the data and messaging requirements just to keep up and to quote that are enormous, let alone to trade it. And now you see, and you multiply that times the trading firms who want to display and make markets out there, and of course to the brokerage firms who need to display that data to their clients and to the vendors out there who are providing all this infrastructure. It's just a enormous challenge. So you're right. Data mitigation has been a huge talking point in the option space for quite some time. And interesting to see that we're starting that to spill over into the reg tech world as well. So hopefully maybe some of these solutions that these startups are coming up with on the reg tech side, we could turn around and implement in the options world as well. Do you have any hope for that, Mike?
Absolutely. And I agree. Nowhere worse than market maker quotes in terms of the amount of data you have to move in order to do your job, right? Because every time the underlying ticks, you've got to update so much of the whole series, right? So much of the whole chain, and basically that explodes messages by 100 or 1,000 or some huge number. And then the problem is it all happens at once, right? When the underlying changes, all of a sudden you have thousands of quotes to update, and that puts an enormous burstiness into the system, and that's an impact not, both in the real-time trading where there's a demand for timely update of quotes, right? You just need to have almost an infinite amount of bandwidth to be able to do that. And then when you have all that data being spewed out of these front office systems, where does it go? And what type of system can accept that and be able to do something with it at the end of the day? And that's a really, really tough technology question, and one that we're definitely interested in ultimately helping to solve.
I like that burstiness. I'm going to have to borrow that from you, Mike. Is that okay with you if I run with that a little bit here on the network?
Yeah, my engineering background coming out. I haven't always been in the capital markets, really. I started my career as an engineer in the Bell system back in a research job in Bell Communications Research back in the 80s. And so, we studied telecommunications and the relationship between computing and telecommunications. And so burstiness is something that you literally study from a mathematical perspective when you're an engineer, and how do you mitigate it and how do you build systems. And so actually a lot of the reasons why, I was kind of oriented towards and excited by some of the challenges that I've faced building trading systems over the years is because I was able to apply some of these fundamental telecommunications and computing related concepts that I did in university and then as a researcher. And that's actually where I got a taste for security. I did work in cryptography and data security back at Bellcore, and now I get the chance to apply that in some very important applications to the capital markets. So it's very exciting for me as the CEO of a firm to see some of these fundamental capabilities that we've been thinking about for so many years really being applied in a very substantive way in the capital markets.
Well, I always love when I can find a new fun niche term to add to my verbiage there. So thank you for that, Mike. I'll be using that. I'll be using that post haste here on the network on some of our tech shows going forward. But we're talking about RegTech. We see some interesting developments in that space. You mentioned, of course, some of the data mitigation being a big trend out there, and scaling and some of the infrastructure things there. And we've also seen some interesting developments, I'd say, on the other side, where a lot of the some of the firms that are starting to explore that space and some of the startups are starting to maybe come up against an interesting maybe ceiling, you could call it, where they're starting to report back that maybe the potential size of the overall RegTech market may not be perhaps as big as some people initially thought, and that's starting to maybe cause a problem for some of the investors and some of the firms. I know some of the big startups that have been in that space, some of them have recently closed, claiming that as a result. You never know if that's the real reason at the end of the day, but that's the reason that's been touted out there. Have you seen or heard any similar complaints, and is this a concern you have for the RegTech market, or do you think this is just kind of the early birthing pains for a market that has a lot of growth ahead of it?
Well, rather than maybe comment directly on the investment community, because I'm not sure that they're really always at the cutting edge of what's going on.
Definitely
I think
not.
That we see this as a larger. I mean, some are clearly, and then some are following a trend, right? But I think that we see the RegTech phenomenon just as part of the FinTech phenomenon, and we don't see it falling off. It's a larger opportunity for us. We see RegTech as a piece of capital markets technology, and we have a concept called market structure technology, where we essentially view that a lot of the way that systems are built, be they RegTech systems or trading systems or matching engines or anything that's being used to actually trade or monitor the capital markets, are being built in general in a very inefficient manner, where there's a balkanization, where you go to some providers for front office technology, other providers for middle office technology, others for back office, and then often people build out parts of it themselves, and then they spend more money by far in gluing everything together than they spent in obtaining the components in the first place. And it's just so much friction to put behind the business of trading. I think that there's a better way. And the better way, the model for the better way, is along the lines of what you see in cloud software as a service, right? If you want to build a retail web retail store, you could build one and support 1 million customers without ever running a web server yourself, okay? You could snap together components, shopping carts, payment systems that are available on a service, software as a service basis in the cloud from the major cloud vendors, and you can scale without building a whole team of integrators in your company. It's not necessary anymore. But that's the exact opposite of how things are built in the capital markets. And there's a reason for that. It's because of these off-the-shelf stacks were not really designed with the needs of the capital markets in mind. They don't have the security elements. They don't have the compliance elements. They're not really designed for the latency characteristics of trading. But that's fine. That doesn't mean you can't build that. And that's our goal as a firm, is to build market structure technology, which is this modular open systems stack for capital markets applications, be they RegTech or trading systems, doesn't matter. That's our vision of how we can have an impact on the capital markets.
Well, Mike, this has been a fascinating and indeed a far-reaching conversation, but we have to wrap it up. But before we go, maybe there's something in this far-reaching conversation that we forgot to hit on, or perhaps you want to leave our audience with a little bit more than you just did, really, of a hint or of a tease of what's coming down the pipe from Thesis in the coming months. It's up to you, sir. The floor is yours.
So I think that we've had a great chat, and I've really enjoyed it, Mark. I think that the one thing I would say is, we took a big step forward as a firm in 2017, being selected to build out the CAT, and we've grown immensely, and we'll continue to grow in 2018 and 2019. And I think where you'll see us is expanding asset classes, expanding geographies, and being known more than just as a respected firm focused in U.S. equities and now options, and then from there we can go to Europe and Asia and look at other asset classes too. So I think what we want to do is really make the concept of market structure technology a global thing, and that's what you should see from us in the future.
Well, Mike, I appreciate you coming on, giving us some insight into the CAT and everything else going on. And we'll take a look at all the fun stuff and see how it's playing out in the marketplace from Thesis in the coming months. Thanks again.
Thanks, Mark.
And thank you for listening, and we'll see you back here for more Options Insider Radio.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.